Well, it has been a historical last couple of weeks in the financial markets, and that has been both on the downside and the upside with the markets. So what we're going to do today is kind of take a lay of the land, look around. We have some really important data sets for you to see that give us clues as to where the markets are going to be going forward. We're also going to check in on inflation, consumer sentiment, and consumer spending. Let's dive into it. Now, before I get into the market update, I want to say that in the last 3 weeks, this will be our 5th video. We have had market updates, including emergency market ups, to keep you informed with what you need to know. So if you haven't before, subscribe to the page, turn on the notifications. You don't want to miss a video. Okay, we're just going to spend the first 2 minutes here on tariffs because most of you don't want to hear much more about them. What we want to talk about is just following up on our last video that we did last week where we talked about the big 3,000 point up day in the markets when Trump pivoted, taking the 90-day pause on against all countries other than China. And just as a reminder of what happened that triggered that. So the 10-year Treasury rate, that has been a key point of the Trump administration wanting that to go lower. And for the first couple days in this tariff regime, that was going down, and it went from about 4.4 to 4%, as you can see there, in the first couple of days. And then you see that sharp move higher from 4% to over 4.5% in just 2 days. That started to shake the financial plumbing, causing a lot of real concerns, and that is what drove Trump to say, okay, I have to back off this now. The reason we're showing this chart today, this is at, it closed, filming this on a Tuesday, and things can move quickly here, but in today, this number is at 4.31%, down from over 4.5% when Trump made the change. We're going to be watching this chart very carefully in the days and weeks to come, because if this starts to rise and go back up, again, this is a problem for mortgage rates, which are back above 7% now, other lending rates for consumers and for businesses when they go to issue bonds. This means their cost of funding is higher. So this is a problem for the economy if this gets up and goes towards the 5% number. Trump blinked when this hit 4.5%, and the question is, will something similar happen with China? In other words, if this starts rising, this could be what triggers him to say, okay, I need to make a deal with China. We're going to be watching this carefully in the days and weeks to come. Now, in the emergency market update videos that we posted, one of the charts we kept referencing was that of the volatility index known as the VIX. And the reason for that is that when markets get extremely volatile, when there's blood in the streets, we have to have a way of measuring, well, what levels of panic are there? And this is maybe the best one of all. And you can see this is a chart of the VIX over the last 5 years. In fact, you will see that it hit over 50, which was the highest level in the last 5 years. It was the second highest level in the last 10 years, only to 4 weeks into the COVID sell-off, where the stock market dropped almost 40%. Everyone was in their homes. There was a deadly virus. That's the only time for 1 week when it was higher than what it was like just a week ago. But we have a chart that we're going to put up here in a second that really illustrates why when volatility reaches these kind of levels, you do not want to panic and sell out of the markets. And that was what we urged clients to do. And we didn't have any clients, not one, who ended up selling. But we said, look, when you look out 6 months, a year, 2 years after volatility spikes like this and these big sell-off events, the markets tend to be much, much higher. This illustrates that. What you're going to see here goes back to 1990 and looks at the highest 1% of VIX levels, which in this case is, let's look at the composite of all the times the VIX got to over 47 versus all the other levels the VIX was at, okay? And look at this on the far left, 1 year later, when the VIX crosses over 47, on average, it has had a gain, the S&P 500, of 36%. Whereas over that time, every other occasion, the average gain has been 12%. That is triple the returns that in a normal market you can expect to get over the following 12 months. That is a really shocking number, very, very solid. And it's the same if you go out 2 years, 3 years, 4 years, and 5 years later. In all those occasions, the market is significantly higher if you are looking at a period where the market's had one of these vicious sell-offs like we just had. So that is the first piece of data that we wanted to highlight from this last sell-off. Now, the second piece is looking at the largest 4-day sell-offs in the S&P 500 going back to 1950. And by the way, this same chart we're going to show you is very similar if you look at 3-day sell-offs. But we had a pretty vicious 4-day sell-off of over 5%. You can see down there the 12th biggest sell-off in this time frame. Now, these are ranking the top 15 largest sell-offs, okay? And there have been some that have been much worse. If you look at 1987, you had Black Monday. The market was down 22% in one day. Okay, so that was a lot worse. But what do all these things have in common is if you look in the green on the right side at the 1 year mark, every 1 year later, from all of these large 4-day sell-offs, the stock market has been higher, and in most cases, much, much higher. And if you look out 3 years and 5 years, same thing. I mean, look at those 5-year returns. Most of those are over 100% returns in the stock market if you are looking at it after a very large 4-day sell-off. So this is the second data point that says, hey, when you see this kind of blood in the streets, you do not want to panic and get out. If anything, you want to look at it for buying opportunities, because looking at a year or two, you're very likely to make a lot of money on other people's panic. Okay. That is the largest 4-day declines and the VIX. Now, the next chart we're going to look at looks at consumer sentiment here, okay? So we're talking about how do consumers feel about the economy? And the answer right now is they don't feel very good. In fact, our reading last week came in at 50.8, as you will see there, which over the last 10 years is right down near the lowest number that this has been. In fact, the only time it's been worse, it was 50 on the dot in the summer of 2022. That's when inflation was peaking up at near 10% year-over-year inflation readings. The stock market had just had a significant sell-off as well, and consumer sentiment was very, very negative. Well, two things I want to take away from this. Number one is the consumer didn't stop spending in the summer and fall of 2022, even though sentiment was very, very negative. Consumer spending continued to be very strong, which is one of the reasons we stayed out of a recession in 2022. Well, let's look at this from another viewpoint also, which is when the consumer sentiment has been in the lowest 5% of readings going back to 1952. So we're in that right now. We were in that summer of 2022. And look at the S&P 500 return over the following 12 months. And we're going to compare this, by the way, with looking at when consumer sentiment was up in the highest 5% of readings. So when are consumers feeling very, very good about the economy and the markets? And the answer is when they're feeling super, super positive, the stock market has not done very well over the following 12 months. Only a 3.9% average gain there in orange. And again, that's because when everyone's feeling good, a lot of times they've put all their money in the markets, they've gotten more aggressive, and forward returns are not as positive then. On the right side there, in blue, the lowest 5% of sentiment readings, an average gain of the markets of 18.7%. So a much, much bigger gain on average 12 months out than when consumers are feeling super, super confident. So when you take this and you combine that with the fact that we had such a large 4-day sell-off and the VIX hit the second highest level in the last 10 years, and you composite all these things together, it tells us that the outlook over the next year to 2 years is very, very good for investment returns. Now let's take a look at the most recent data on inflation, and that's for a couple reasons. One is that with the looming tariffs, there is concerns over what will be the inflationary impact. Are we going to have another surge in inflation like we did a couple years ago? Now, the first thing I want to mention is that in the 2018 and 19 trade wars, when we had a lot of tariffs put in place on China, the EU, Canada, Mexico, then inflation did not even go up a tick. It stayed around the 2% level. So tariffs don't have to be inflationary. That's the first thing. The second thing is when we look at the state of play right now, things are pretty positive. And what am I talking about? First, I'm talking about barrel of oil is down to $61 a barrel, much, much lower than it's been the last 4 or 5 years, when it tended to be in a range between 70 and 90 for most of that time period. So it's very good to see oil down. The second thing is when we look at commodities, and commodities, we're talking about energy like oil and gas, precious metals, which is gold and silver, agriculture, corn, wheat, sugar, etc., and industrial metals like copper and aluminum. There is a way to measure a composite of these that is an ETF. PDBC is the ticker symbol. And this is a chart of this measure of commodities over the last 10 years. And note, from late 2020 to early 2022, this skyrocketed. And this is what inflationary spikes tend to look like. Oil went up to almost $120 a barrel. All commodity crosses kind of across the board were skyrocketing. Well, look at the case now. In fact, we are at outside of, for about a month in 2020, when the economy was shut down and there was virtually no demand for any of these commodities, we see today commodities at the lowest level in the last 10 years. So again, this is not the picture of an environment where inflation is on the cusp of being out of control. So we are very happy to see that. That's on commodities. Now, we got last week the Consumer Price Index, which measures inflation both month over month and year over year, and we got very good news on both. On the year over year, okay, this came in at 2.39%, which was the lowest number since February of 21, when inflation was on the way to its 10%, nearly 10% peak in 2022. So the reason I'm highlighting this, and I just want to mention, this is not saying price levels are back to where they were. Now on commodities earlier, that's saying yes, prices are at the lowest levels basically in the last 10 years. Here we're talking about percentages year over year. And so prices are still much higher across the board for consumers than they were 4 or 5 years ago. Pretty much everybody knows that. But what this is saying here is the Fed's goal is to get inflation to 2%, and it's at 2.39 right now. So this is something they're going to be very, very happy with. And the Fed has a lot of room to cut interest rates, but they want to know that inflation's not going to start to rise like it did back a few years ago. Now that's year over year. This is the best news. When you look at month over month, this actually went down 0.1% prices declined for consumers last month. And you can see in the last 5 years, let's see. Yes, about the last 4 or 5 years, that has not happened before. So this was the very first time. So we like to see this. By the way, we got the Producer Price Index, which is also business inflation, wholesale inflation, and that declined almost 0.5%, which it has declined a couple times in the last 3 or 4 years, but 0.5% was very, very solid there. So when you look at the inflation picture right now, I would say that it's one that most of the news is really, really strong. We're going to watch to see in the coming weeks and months what the tariff picture does to inflation, but we're going into it from a good place, and that is very good news. Now, before I get to my last point, I want to mention that if you have been on the fence about getting a second opinion with your financial plan, with your investments, now is the time to reach out. Listen, if your advisor has not been doing two things, number one, reaching out to you and keeping you updated with the market moves and what's been taking place, and two, making adjustments in the portfolio, taking advantage of some of the opportunities that have presented themselves. If both those things haven't been happening, go to centeracapital.com, reach out to us. You can schedule a conversation. We'd love to hear from you. Okay. Let me mention one quick thing that I want to highlight, which is we have talked about some of the data that's emerged in the smoldering ashes of the markets over the last couple of weeks, and how it's very important to know that a year, 2 years out, the markets tend to be much, much higher. I want to say that in the very short term, looking out a month, 2 months, we don't know where the market's going to go during that time period. The main reason for that is we don't know what the impact of all of this upheaval this last month or couple weeks has been on the consumer and on corporations. What are they going to do with the jobs market? So that is something that we are going to be keeping you up to date on, because that will determine whether a recession is a possibility. Right now, we don't see the data that supports that, or whether we're going to bypass a recession, which if so, the market is very likely seen its low, and the markets are going to be in a good place going forward. Okay, to help us determine where is the consumer right now, we are looking at data that we get weekly. Because look, a lot of the data in the financial markets looks back 2 weeks or a month. Not these next two that we're talking about. The first is the jobs market. Initial claims for unemployment insurance came in last Thursday, at 223,000 people filing. And you'll note, we've been highlighting this for basically 3 years and making the claim that there is not going to be a recession, and we've been right that whole time. And you can see there still is not an uptick in claims. This is very, very good news, because when the consumer has jobs, they spend money. All right, the last chart, the Red Book Index, which measures retail sales. This is a weekly data series, and it compares it to 1 week or a year ago at the same time. And you will see, and we just got that today on Tuesday, 6.6% year-over-year gains. Last week was above 7.1% year-over-year gains. What is this telling us? The consumer is still outspending. So very similar so far to 2022, summer of 22, when we just showed you consumer spending was very, very low. That's the case now, but they're still spending. As long as this happens, a recession is very likely to be avoided. So today we talked about the yield on a 10-year Treasury, we talked about the VIX, we talked about inflation rate. So if any of you are still awake, God bless you after going over those topics. But seriously, there is a lot going on in the markets, but we're here to guide you through it. There is a light at the end of the tunnel, but we'll continue to be here for you. Thanks for watching, and take care.